So just following on from what we were speaking about in the previous video with regards to the order filling and the liquidity and the depth market on the ladder, how does that then relay into charts? So luckily this simulation, this is the wrong simulation. Open up a chart. So with this simulation, it's a very good simulation. It's real time. It's the desktop version is 10 minutes delayed, but this one is real time, and it our price movements, whatever we do on the price ladder in terms of orders, is then reflected on the price chart. So I'm going to open up the, the chart for for cable, the Great British Pound versus US dollar futures. We're going to go to the June contract because the currencies are traded quarterly. Hence, obviously, the VIP group, what we spoke about with the quarters and the expirations. So let's just fill 100 orders at 24.05. We want to price up to 10, so we need to fill 100 orders, but we haven't got 100 contracts to trade with up until what we've got 22, so it's 30. 50, 70. We can probably fill up to about 100, 24.08. So let's go ahead and buy 100 contracts up to 24.08. There we go. And you can see the price here. So watch the price on the chart when I fill the order. So this is the price, and obviously this is the chart. And all the chart does is display what happens on this price ladder in a time controlled format. In this case, it's just a 1 minute chart. So I've just paid 24.06s for 100 contracts. I'm just going to take the loss. I need to just close the position. I'm not happy with the long. We're going to close it. There's quite a lot of liquidity on the buy side, so we can probably get away with only 5 prices being shifted. But watch the price movement here on the chart when we sell the 100 contracts. I'm still being filled. I've got 29 left to fill on the offer. I'm going to move it down just because I want the fill, and I'm going to move it down again. There we go. So see how the price moved down? Because I dictated price there, albeit on a simulation, to trade lower. However, the market, and especially the market makers, were pricing higher. So we needed to return back to where we were trading. All I'm doing is just a speed bump in the way of where price needs to go. With that 100 lot, that's all I'm doing. And it gets interesting when, let's just assume that we are a hedge fund. We have 10 billion. We're a $10 billion hedge fund. We're not going to be trading 100 lots in the futures. We're going to be trading huge volume. Now, unfortunately, I can't trade on this system. The demo, so it only allows me to trade a maximum of 100 lots at any time. So I'm going to be an aggressive seller, and this is perfectly legal. There's nothing wrong with doing this. That provided it's an intentional trade or an intentional client order, there's nothing wrong with doing what I'm about to show you. There's no, it's not necessarily either. It's not necessarily a malicious move to run stops or to do anything like that. It's simply just to fill a large order. So if I'm a hedge fund, I now need to fill 2,000 contracts. So let's see what happens when we need to fill 2,000 contracts. We can sit with 2,000 contracts here. On the offer, and we can wait patiently for our fill. That's 2,000. There we go. So we've got 2,000 there on the offer at 24.14, or we can be an aggressive trader and we can move our order to just sell at market, and we can strip the market quite substantially. So just watch the price chart of what actually happens there. See how we've just forced and dictated. We've taken all the bids in the market. If this was a live scenario, the chances are we would see a large increase of bids stepping in. I'm going to cancel the order, and we're going to wait for the market to return back to where we see the liquidity. So you can see the bids stepping in, and as you can see on the chart, we have a huge wick. So I am a hedge fund, so I'm now looking to fill the remainder 1,600 contracts. So I'm going to just get my order ready. And when I'm looking at the chart, I want to see the chart. This is where it becomes malicious, or it becomes um, intrusive, if you like, into other traders' books and into other traders' orders. So I'm just looking at it, and we for whatever reason, we identify this low here to have stops below the market. So we have a large drop down. We now identify lows, stops at 83. So what do? We move our offer down to 80s, and we continue to shank, as it's known, the price lower until we get the fill. I'm going to pull the orders, and we're going to wait for the price to return back to where we go. And generally, what we see is typically what we'll see is this scenario happen on a daily basis. So we've just run our orders down. Everyone is actually stopped out from a long position, and the market will now continue to run higher up onto this area here. Now, as I say, that was assuming we were a hedge fund. From a market making perspective, we are there to facilitate that trade, and we're the ones taking the other side of that order. So when we're having our order down here at 80s, 2380s, who's the counterparty? You know, there's many people in the market at the moment that can be buying off of our offer, but there's a higher chance that the counterparty will be algorithms, so machine or systematic traders, and largely market makers.